Good afternoon, everyone. Welcome to our presentation today. We're going to be talking a little bit more about debt repayment strategies. So to jump right in, the first thing we want to let you know is that we have gone ahead and muted everyone on the call except for our presenters today. We just want to make sure that you can continue doing whatever you need to do during this presentation, but you're able to just hear our voices. So if you need to continue eating lunch, or maybe you have some kids in the background to wrangle, that is totally fine. We completely understand, but we want to make sure that you can hear our voices too. This doesn't mean that we don't want you asking questions throughout the presentation and at the end, but there is a feature that you can use to ask those questions. Either on the right-hand side of your screen or at the top of your navigation bar, whichever way you logged in today, there will be a place where you can ask questions. And this can be used at any time during our presentation, but first we want to test it out to make sure, number one, you can hear us, and number two, that you know where the questions feature is. If you could just let us know where you're joining us from today in the questions feature, either on the right-hand side of your screen or at the top of your navigation. When you let us know where you're joining us from, that just helps us to know, okay, they can hear us and they know where that questions feature is. So it looks like some people, awesome, Boston, some people are joining us from Somerville. Great. We've got people joining us from Cambridge. Awesome. Great. You can keep submitting those, and that is where you'll ask questions throughout our presentation today. So don't hesitate. If at any point you have a question, please put it in there. That's great to see. We've got some people from Middleborough, Nantucket. Wow, wonderful. So it's great to have you all here today. The presentation is being recorded today, so if you are not able to take notes, if you're, doing some multitasking, that's okay. We will have it recorded and it will be posted to our YouTube channel so that you can rewatch it. If you want to go back and kind of remember, oh yeah, they talked about that, but I don't remember every detail, you can always go back and watch it again. We will be sending out an email within about 48 hours of our presentation with the link to our YouTube channel, as well as other resources that can be used. So please don't hesitate. If there's a question that comes up even after the presentation, that's our contact information. It's coming directly from us. So you can always shoot us an email back, and we're happy to answer any questions there as well. I'm Sarah Scruggs. I'm the Community Engagement Specialist at the Harvard University Employees Credit Union, and I'll be going over the first half of our information today. And then Migdalia Gomez, our Community Engagement Manager at the Credit Union, will take over for the second half, and we'll both be answering questions throughout the presentation. So whatever we can do to help, we are here to do that. Harvard University Employees Credit Union, or HUECU, as you might see on a lot of our swag, is a financial institution that is not for profit. We are made exclusively for the Harvard community, including all of our Harvard teaching hospitals. So all of the hospitals that you all work at or at MGB, you all are a part of our membership, and we believe that we have everything that a bank does, but we believe we do it a little bit better. Better value, service, better business model, and we believe we're better for the community. For us, it's extremely important that all of our products are focused on our community of members and not just out there just because, but they're focused on our members. Not only our products, but also our offerings of free financial education, like today. And so really, if you have any questions about joining the credit union, or if you're interested, you can always reach out to me or Migdalia and we'd help you through that process. But we're glad that you're here and you've joined us today. I'm going to turn it over to Kimberly to talk a little bit more about EAP.
Thank you, Sarah. Welcome, everybody. My name is Kimberly Smith. I am part of the Mass General Brigham Employee Assistance Program. So this is offered to you all. We are a free, confidential work-life resource. So just as the slide shows here, we do assessment, we help with short-term problem solving, and we also help you find referrals to community resources. So some of the things here that we do work with employees on would be personal and well-being, workplace and family life issues. We have a wonderful new website that we launched just a few days ago. So it's eap.partners.org. down there at the bottom, and fabulous resources, a lot of great vetted information, as well as how to make an appointment with us. And you can also just give us a call at that number, 1-866-724-4327, and you'll get connected to one of our EAP clinicians who can answer questions about any of these resources or provide you with some support. We offer 24/7 coverage. So if you are a non-traditional scheduled employee and you work maybe weekends or different hours, just know that we are available 24/7 for you and can take phone calls no matter the day or time. I think is this my only slide, Sarah?
Yes, it is,
Okay.
Kimberly.
All right. So feel free to reach out to any of us via the website or the phone number that's listed here, and we look forward to supporting you. And this is a great presentation, and we're happy you're all here. So thank you so much.
Thanks, Kimberly. A great opportunity here, and we've partnered with MGB EAP to bring you all a series of presentations throughout this year. So you can always find that information on our website if you're interested in particularly personal finance and learning more about personal finance issues for you and your family members. So as we dive into our topic today, we really have to start with step one. We have a few different steps in this debt repayment presentation. And when we're starting with step one, we're thinking about our goals. So yes, we're all here because we want to repay our debt. But what is our goal at the end of that? When you're thinking about debt repayment, what comes to mind of once I finish paying this debt, I'll be able to. And that's something we want you to think about because that's what's going to motivate you through this process. Debt repayment is not easy to be motivated by. I'll be honest, it's not something that everybody is like, woohoo, I get to repay all of this money, yay. But what's really going to motivate us is our end goal. When I repay this debt, I will be able to. What is that for you? Because that's going to keep us moving even through times when they do get tougher, when we want to give up, when we feel like we're never going to reach our end goal, we can always look towards that goal. So I want you to have that in mind. Maybe you're one of those people who maybe at this point you don't really know, okay, what is something that I'm looking forward to, or what would be a priority once I get this debt paid off? Our partners at Green Path Financial Wellness, who you'll hear a little bit more about at the end of our presentation, have put together a great workbook called Aligning Priorities. And we are putting this up on our website, and you'll have access to that hopefully during from your email that we send in about 48 hours. But this workbook is really for people who kind of need to line up, okay, you know, I have this amount of money in my budget and now I want to prioritize where that money goes. This is a great place to start. And maybe you've already completed that step and you don't need to use the workbook. That's totally okay too. But this is a good place to start for people who maybe just need a little bit of kickstart and wondering, okay, this is my money. Where should it be going? Especially if you're in a time where it's a little bit uncertain. This is a good place to start when you can align your priorities of, okay, these are the things I need to be using my money towards, and these are things that are wants, but they may not be a priority for me now. So like I said, we have to start somewhere. And yes, we started with our goal, step one. Let's start with also kind of looking through the numbers. What do we owe? Maybe you have just one large debt that you're hoping to pay off, but maybe you have multiple debts. Maybe that's not your only debt, and you're hoping to pay off multiple debts. Maybe you're one of those people who's never really kept up with it. You kind of just set it and forget it, and you don't really know exactly, okay, what am I paying towards this specific loan monthly? So it's time to kind of sit down and start thinking through those things. I really recommend sitting down, getting all of that financial information together, and figuring out, what do I have left to pay? What do I have left to pay on these loans that I'm thinking through? And how can I best get there? So first you need to sit down and really just think through, what do I owe? What's your credit score? This is a good thing to think about now because we'll talk about refinancing later on in our presentation. And if you don't know your credit score, you may not be able to best help your refinancing strategy. So we want you to make sure that you know your credit score so that you're able to make best decisions for you in the future. If you've never checked your credit score before, a really great place to go would be if you do have a credit card. A lot of the apps at this point will have your credit score included on there. So I highly recommend that if you do have a credit card. If you're a member of the credit union and you have our credit card, you can find it on our app. I know my credit card from a different company definitely has my credit score there. And there are other ways to find it as well. So just go and try to figure out, okay, what is my credit score? Where am I right now? Because credit score does have an impact when you're thinking about taking out additional lines of credit possibly in the future. Now we need to get to the really fun part. Everybody gets really excited about this, but this is calculating the cost of our debt. This is actually an important piece of the puzzle. And I was joking a little bit when I said it's everyone's favorite part. This can be a really tough thing to do, to sit down and really see not only what we owe, but what it's costing us to borrow this money. So let me show you an example of what I mean. Here we've listed out, okay, we've done the first four things when we've calculated the cost of our debt. $10,000 debt at 7.5% interest for 120 months. And our monthly payment is $119. But what we really want to see the cost of is that total interest paid, because that is money that's just going to pay to have that debt. This isn't money that's going towards the principal, which would be the $10,000. When we say principal, that means the amount of money you borrowed on the loan. And then the total interest is what you're paying, what it's costing you just to keep up this debt. And so we really want you to do this with each of your loans so that you can see, okay, this is exactly how much it's costing me. And maybe these strategies that we're coming up on in the next few slides will help me to be able to lower the cost of the debt that I have. And you see there that we also have a $5,000 principal debt with 18% interest for 60 months, and our monthly payment is $127. The total interest paid over the life of the loan, which would be after 60 months, would be $2,618. So a little over half of the principal amount we're paying in interest. So that's something to keep in mind when you're thinking about your own debt. It's important to list these things out, no matter how much you don't want to see it. It is important to know. And at the end of the day, we put these two together. So every month we're paying $246 towards our debts. And the amount of total interest it will cost to have this debt, both of these debts together, is $6,862. That's quite a bit of money that we're paying on interest. That's not even the money that we're borrowing. This is the cost to borrow that money. And so this is really important to understand how much this number actually is for you and for the debts that you hold right now. Because if you don't know this number, you can't strategize to possibly decrease it or work to pay it off sooner. It's important that you know these numbers, you know these terms, so that you can then have a plan moving forward. Now we're to step 2. We've made our goal, so we have what motivates us. We also have our debt sitting in front of us. We know the numbers, we know what's happening there. Now we have strategies for how we can tackle this. So we have two pretty popular strategies for debt repayment, the Snowball method and the Avalanche method. We all are very well acquainted with snowballs here in the north. As you look outside today, we're very well acquainted with that. A snowball really means that you're starting from something small and it's getting larger. And so when we think about this with debt, we are going to focus on the smallest amount of debt that we have. So let's say we have 3 different debts. We have $10,000, we have one at $15,000, and we have one that's $4,000. So we're going to start with our $4,000 amount of debt with the snowball method. Why would we do this? We're doing this because maybe you're the type of person who's most motivated by reaching your goals. And once you reach one goal, it really propels you forward to reach your larger goal of paying off all of your debt. I'll be honest, this is totally my personality. If I'm going to ever reach a goal, it better have 5 goals before that I can reach on the way to it. I don't know you're if you're like me and you love checklists and you love being able to just check off a task that you've done because it gives you a sense of gratification, that is absolutely me. And the snowball method would work best for me because you're able to pay that on that smallest debt. And so you will end up paying that debt off faster than you would if you started with the largest debt or another strategy that you may use. So when you pay off that smallest debt first, you're really able to get that gratification and able to see yourself pushing towards the actual big finish line. This is also called goal gradient theory. It's important that you make minimum payments on all of your debts. If at this point, making the minimum payment on all of your debt is what's in your budget, then that's what you need to do. But if you have additional money to pay off, parts of additional debt, this would be the strategy to use and making those extra payments on the smallest loan, even if it's just $10, $15, $20. I highly recommend making those extra payments and putting them towards a strategy. Then when our $4,000 is paid off, we would move on to the next smallest loan amount. So that would be, in the example I gave, the $10,000 debt that we'd move on to, because when that is paid off, you then reach the next largest debt. And then once that's paid off, you would finish. You would be there. You'd be at your goal. And so when you focus on the smallest amount, you're able to really feel empowered to go ahead and conquer those next few debts that you have as well. Another method would be the avalanche method. With avalanches, we're focusing on the highest interest first. With avalanche, we're focused on the highest interest, so the highest amount that it's costing you to have this debt. In our previous example on the slide prior, the highest amount of interest was on our $5,000 debt. So we would still focus on that $5,000 debt with Avalanche method because it was at 18% interest. So that's important to keep in mind that we're focusing on the highest interest rate, not the highest amount of debt, but the highest interest rate, because in the long run, that could save us money, save us the cost. And so this is really for people who you are just ready to save some money. You are ready to be focused on the largest interest rate and really tackle that debt down. And so like the snowball, you'd make minimum payments on each of your debts. That is just what we need to be doing. For our credit score and for possibly getting lines of credit in the future, you need to make those minimum payments on each of your debts if possible. That is extremely important. But then maybe you have an additional $20 in your budget that you can put towards paying off debt. So you would put it towards that 18% interest, and you'd put that towards it each month, and you'd start paying it down a little bit quicker. And this, in the long run, will save you a little bit of money. But if you're not motivated to actually continue paying it off at that rate, then you're probably not going to save money in the end. So that's why it's so important to make sure that you pick a method that works with your personality. When it's paid off, you move to the next debt with the highest interest rate. So that's what you have to keep in mind, is that Avalanche has to do with the highest interest rate, while Snowball focuses on the smallest amount of debt. If you're a visual person, maybe seeing it put a different way will help. With Debt Snowball, you start at the top with the least amount of money, right? You're focusing on the smallest amount of money, and that's where you're going to put those extra payments. With Avalanche, you're going to focus on the highest interest rate. So those dollar signs at the bottom are for highest interest rate. And so it's important to keep in mind that those two things are just a little bit different, but they can really match up well with specific personalities. Maybe there's one that fits you a little bit better than the others. Like I said, a little goes a long way. We want you to be able to see this in an example, a very clear example. So let's say you have that $10,000 loan at 7% interest. Your monthly payment right now is $200 a month. The total interest paid, or the cost of the loan, would be $1,858 over the life of the loan. You have 60 months to pay this. So you're paying $200 for 60 months, and the cost of that loan is $1,858 over the life of the loan. Well, let's say that we are working our budget, we're seeing that maybe we're spending a little less on a specific thing, and we have $20, we have $20 that we can put towards our debts specifically. So we put $25, just $25 more dollars a month towards this loan. The total interest paid will come down about $250 just because you're paying $25 additional per month. So the cost of the loan comes down by about $250. Not only that, you're also saving yourself 8 months in not paying $225 a month. So that's money back in your pocket, and it's time back given to you, where you can maybe put that money towards a different debt, or maybe you can put that money towards something that you're wanting, maybe reaching one of those larger goals we talked about in the beginning. Well, let's say we just put an additional $50 towards this debt. That would save us about $400 in cost of the loan over the life of the loan, and it would save us about a year and 2 months of not paying on this loan. And time can be a great thing as well. So maybe after those 46 months, you can start paying down aggressively on another debt that you have. That's a great idea. That can really save you time overall, not just for this one loan, but for all of the loans that you possibly have. So it's important that you understand even a little bit, that you strategize and put towards specific loans will help you reach your goals faster. I'm going to hand it over to Migdalia, who will get us started on thinking through some of our other options.
Thank you, Sarah, and thank you again, everyone, for joining. Just wanted to read out one of the questions that came in. Will the slides be sent to us? And yes, we will email you the presentation so that you have access to the slides. And if there are any other questions, please feel free to continue using the questions panel to submit those. Sarah walked us through some ways that we can outsmart our debt and accelerate debt repayment when it comes to different strategies that are based off of our cash flow. It's also based off of our personalities. Now I'm going to walk us through what are some of the things that you can do with a lender or the company that may potentially have your debt. One of the things that we always recommend is speaking with the lender. You'll see that we have a couple of different options. Before we talk about refinancing, which we'll talk about shortly, we want you to be aware that just because you have a debt at a certain percentage interest rate and a certain term does not mean that it's going to 100% have to stay like that. Even before COVID, lenders had different options in place, different procedures, and essentially just options to help their borrowers who may have difficulties paying off their debt. Some of these things include option to skip a payment, in which you could contact your lender. This is very common with auto loans. You can contact your lender and just say, you know what, can I skip next month's payment? You don't even really need to provide much explanation, but you just can call them. Typically it was once for the lifetime of the loan. Some lenders are a little bit different and may provide it more often, but you could choose to skip a month. For some lenders, you can skip up to 3 months. That was something that we at the credit union offered to help our members with COVID expenses, and a lot of our members their income might have changed, so we gave them that option. This is to say that before you go into looking at refinancing, see if that is an option, because if you are looking to increase your monthly cash flow and your lender already has something in place, that may be the first step, even if you then continue on to refinance, or if you continue to utilize the different payment strategies that Sarah went through, that may give you a little bit more flexibility. With that skip a payment though, keep in mind that you still would be required to make a payment. You're just deferring it. And that's another way that we're more used to hearing of that term. It's deferring a loan payment. It's very common with student loans. Right now, we don't recommend that you refinance or look to work with a different company with your federal loans, because payment right now is at zero. You don't have to make a payment if you have a federal student loan, because the interest rate has been reduced to 0%. That's going to be something that you're not going to be able to get with any other entity right now. There are some that can reduce your interest rate. So some lenders may say, you know what, we can't do a skip a payment. So you cannot defer your payment a month or two. But what we could do is we can drop your interest rate from X to Y. That is a very common strategy with credit card companies, especially during COVID times. We've seen many credit card companies, and even, I know we're talking specifically about debt, but just so that you're aware, even utility companies, a lot of them are dropping their charges or offering discounts, but cell phone companies as well, cable companies we've seen do this. They're not promoting it, but if you were to call and ask, they may have these options available to you. So before you think about maybe moving your credit card from one company to another, doing a credit card balance transfer, which is when you pay credit card A off by bringing that debt to credit card company B, before doing that, find out if your credit card can offer you a lower interest rate. Many credit card companies and businesses throughout these times, they don't want to lose a customer. They understand we're in a global pandemic. They want to help the community that they serve, and they may already have something in place, but they're not necessarily going to promote it, because they may not be able to offer this to everyone. They may only be able to offer it to those that need the assistance. Therefore, we recommend giving them a call. And when you call, you want to make sure you're speaking to the person that can help you. There are many times that you may call, and depending a lot, and we've seen this not so much for us at the credit union, but we have seen or heard this, that sometimes individuals are calling credit card companies, and the person that's on the phone with them has been recently trained, so they may not have that information. So you always want to start off with, this is what I'm looking for, whom should I speak with? And make sure that they put you in contact with someone that can help you. Another option, and this one will seem a little bit out there, is proposing a new payment. But before you go to even proposing a payment, you have to go through the process of looking at your budget. If you don't have one, we're not here to judge anyone. We're all adults. We have different competing priorities. So if you don't have a budget, it's a good opportunity to create one. It'll just help you determine how much can you comfortably pay towards XYZ debt per month. Once you have that idea, let's say that I did my budget, I have all these competing expenses, and realistically, I can only pay $100, but my monthly payment is $120. Instead of me making that $100 payment and always being late and getting that late fee, contact the lender, speak with them, contact your company, find out what options they have for you. They may be able to do a combination. They may be able to reduce your interest rate for a certain time period or defer payment for a certain time period. Keep in mind, anytime you defer, that it does have to be repaid. So we only recommend deferring if you really are in a situation that you need the cash flow and you're just unable to make payments otherwise. It's really important to keep that in mind. Just because we defer it does not mean that it goes away. It just means that we have to deal with it at a later point. And anytime you're speaking with anyone that has essentially an impact on your finances, you want to make sure you keep a paper trail, or that you keep their contact information when you spoke with them. I recommend, everyone's different, so you know what works best for you. I'm a little old school, and I still like to keep things in a notebook. It's just easier for me. If you are an email person, that's fine. Just make sure if everything that you're keeping, if you are going to keep something in your email, make sure that it's via secure email so that that information is not compromised should your email be compromised. Next, we're going to talk about refinancing. And this is really, when people think about debt repayment, typically the first thing that you think about is, well, I have XYZ debt, I want to pay it off, I'm going to refinance. And that can be a great strategy for a lot of individuals, but there's a reason that we held off talking about talking about refinancing until halfway into our presentation. We want to make sure you're thinking holistically at all the different options that you have to repay your debt. Refinancing is a great option for some of you, but it could even be a better option if you combine it with the Snowball method, or if you combine it with any of the other pieces that Sarah spoke about earlier. So what exactly is refinancing? A lot of us have different financial backgrounds, so we always want to make sure we start at the same point for all of us. Refinancing ultimately is taking a debt that you have with company A and taking out a loan with company B that pays off company A. So really, it's a new loan that pays off an old loan. So let's say I have a $5,000 loan, and let's call it a car loan just for an easy example today. If I have a car loan for $5,000 and the interest rate is maybe 7%, I can go to company B, who does not have my car loan, and refinance the car loan with them. So they would pay off that $5,000 loan to company A, and now I would have a new loan with company B. So my payments would be with company B. Company A's loan would appear as paid off in full on my credit report. I no longer have to make payments to company A. But why would I do this? What are some benefits of refinancing? Well, there are a couple of benefits to refinancing, and you'll see them show up here. And the main reason for most people as to why they will refinance is it's going to be a lower interest rate. And for some individuals, that is usually the main reason, because once you have that lower interest rate, it allows you to save money. In addition to having that lower interest rate, it's going to save you money in a couple of different ways. You can have a lower interest rate where it saves you money throughout the life of the loan, or if you extend the term of the loan, you may not save that much on the interest rate, but you're giving yourself more monthly cash flow. So what does that mean exactly? There are times, and this is very common, and I'll step back for a moment. Refinancing, you can refinance pretty much everything. So you can refinance an auto loan, you can refinance a mortgage, an equity, a second mortgage on the home, you can refinance credit card debt, personal loans, you can refinance student loans. So essentially any loan that you have taken, maybe you took out the loan, 2-3 years ago. Any loans that were taken out before 2020 probably could benefit from looking to see if you can refinance, because the rates have gone down significantly. I'll give you a couple of examples for rates, but the biggest thing I would recommend is check your financial institution. Some financial institutions are a little bit more transparent than others. I always encourage folks, go on our website, HBCU, even if you're not a member. We have our rates out there so that it gives you at least a basis when you're comparing other rates. But if you have a car loan and it's anything over 3%, take a look to see if you can refinance. If you have a mortgage and it's anything above 3.5%, if you have student loans that are not federal, because remember, federal student loans are at 0% right now. You're not going to be able to beat that if you bring it over to a private company. So if you have private student loans and it's anything above 4 or 5, you may want to take a look to see if you can possibly refinance. And credit card, honestly, with credit card debt, if you have any interest rate that's in the double digits and you're carrying a balance, definitely worth looking to see if you can refinance or essentially consolidate or do a debt balance transfer. But before you do that, contact your lender, because your credit card company may just be able to drop your rate. And if so, it just saves you the process of having to take out a new credit card and do the balance transfer. So just see if you can do that first. Well, let me go back to my second point about extending the loan terms. There are times that you can decide that you want to refinance just to extend the loan terms. So the interest rate may not change substantially. Let's say that I have a $10,000 loan and it's scheduled to be paid off in 3 years. And at first, when I took out that, I thought it was going to be doable, but life has changed as we've seen. My expenses have changed, maybe my income has changed, and I need more time. I need more than 3 years to make those monthly payments. I could choose to refinance, maybe at the same rate or similar. Might not be much of a change. There are times you could go up a little bit. I usually don't recommend that, but there are situations that it may make sense for you to do that, but I usually try not to go higher. But let's say that my rate is at 6%. I might be able to go down to 5.5 and extend it instead of 3 years to 5 years. So having that extra 2 years would mean that my monthly payment would be lower. The benefit, I don't have to feel as financially stressed every month as I'm making those payments. Keep in mind though, because you've extended the terms, how much you pay in total interest, or again, the total cost of that loan may now be higher. We'll do a couple of examples in the next couple of slides to show you how to calculate this. And as I dropped in the chat, we just used our calculators. Feel free, our calculators, they work for us, but if you prefer another one, that's fine. Just make sure you do the math before you sign off. And if you are going to go with one of those options or any options when you refinance, just make sure that there's no prepayment penalty. Typically there aren't. This just means that if you are in a position in the future, which I hope we all will be, that maybe in the next couple of months, next couple of weeks, next year, things are starting to look up, the economy starts to recover, incomes are going up, and you want to pay off earlier, just want to make sure that you can without incurring any fees. And that information has to be disclosed to you as part of truth in lending conditions that are mandated by the federal government. So talked a lot, gave you a lot of information, but let's look at the numbers now. So here we have an example of a $10,000 loan that we're making $200 payments for 60 months or 5 years. Remember, we always calculate what is the interest paid, or again, the cost of the loan. How much does it cost me to pay for this loan? I want you to think of it as the cost of the loan because it has more of a ping. It has more of an emotional, not want to say distress, but you can feel it. Like you can feel like, oh, it cost me how much versus total interest paid. Total interest paid is just financial jargon. Don't really have any sort of emotional attachment or emotional reaction to that. But if you think about total cost of the loan, that is money that we're giving away. That is money that we could be using for something else. And we believe strongly in using behavioral finance science to help us improve our habits. And when we can get a feeling, like when we can feel the fact that, oh, it's like we're throwing that money away, we're giving it away in interest. So think about it that way, that's the cost of that loan. It's going to be $1,858. So if we can refinance, which is very doable, down to 5%, so it's 2% decrease. And I've seen people, different, it depends on when they borrowed and what their credit score is, but definitely have seen people save various interest rate points. So it is doable to go down 2%, even more. In this case, you're going to look at it, it's like, oh, okay, I'm only saving $11 a month. Okay, yeah, that's true, but you're saving $535. That's $535 that you can use on something else. I don't know about you, but I'm pretty sure I can find something else to spend $500 on than to give it away to a lender. In this case, we kept the terms the same. So we decided we're going to still keep it at that 5 year. And that is something you can choose to do. Every lender will be different. But mortgages are something that if you do have a mortgage, and let's say you've been in that house for 10 years and the mortgage you took out was for 30 years, keep in mind that when you refinance, you don't have to go with another 30-year loan. You can choose to go to 20, 15. There are different years. Sometimes you may want to extend it for 30 years, but just know that if you don't have to. The same thing when you're refinancing. You don't have to go with the highest amount. They have typically different term options. And if they don't, what you could do is continue to just pay what you were paying before. When you refinance, they're going to tell you your new monthly payment is X. So in this case, it's $189. But if I'm comfortable paying $200, keep paying that $200 because it's going to save you a little bit more in interest. So again, that money that we're giving away that we can use towards other financial goals, and it'll save you time. And time is really important. We don't usually think about time when we think about debt repayment as a benefit, but that's a huge benefit. To be able to be paid off 3 months earlier, just to think about that, it makes me smile. It's just like, oh, I could be done earlier. That's 3 months that I can take that money and apply it to something else. So it's just think about the time. So sometimes it may not just be the cost, but the time that you're saving. There are a couple of different things to consider before you refinance. Interest rate is the one that we spoke the most about, but it's not just the interest rate. There are going to be different options available to you when you start researching different refinancing options. At this point, a lot of rates are fixed. They're significantly low. Variable may be good for now because they're low, but we don't know what they're going to be in the future. So if you are going to go with a variable rate, just keep in mind, what if the rate went up? And when you do apply for these loans, they will tell you what's the maximum rate that they can charge if it's a variable rate. Just keep in mind, if it's a longer term loan, depending on the balance of that loan, how would you be able to comfortably make those payments if the rate increased substantially? Let's say I have a $5,000 loan and the rates are low right now, and I do have some money in savings, so I could technically pull from that if I needed to, and I'm trying to pay this loan off in 3 years. I'm like, okay, I think I can pay off $5,000 in 3 years at a low variable rate, so I'm going to go with it. But if halfway through the repayment that rate doubles, I have the option, because it's a lower balance, that 5,000, I could try to pay it off sooner, maybe pull from my savings, maybe accelerate savings. So it gives me more flexibility. But what if that loan was a mortgage? What if it was for 30 years and the rate starts at 3% but could go up to 7 or 10%? That's going to be a significant change to my income, and it's for a much longer period and higher amount. So you just want to make sure if it's variable, that it's something that you're comfortable paying off in the near future, and that you could be able to absorb the increase should that interest rate go up. And often I get people asking, well, if it's variable, couldn't I refinance? That is true, you usually can, but just keep in mind the rates are going to be higher regardless. Because if the variable rate is going to increase, that typically means that the fixed rate will also increase. So yes, you can refinance, but you're still going to probably end up with a higher rate than you started with. Benefits, I've spoken about this often with the federal loans. When you take out a new loan, it's a new loan. So any benefits that you had with your previous loan, those are gone. You've paid that loan off. You no longer are working with that other lender. You can't continue to essentially work with that company. You've closed the door. It's like, I think of it as when you refinance, it's literally moving. It's if you lived in one apartment and then moved to another apartment or one house to another, you can't go back to your old house that you've sold to someone else, or your place that is now being rented by a different tenant, and say, oh, I actually really like the amenities of this building, so can I just use the dishwasher because I don't have one in my place? You can't do that. So when it comes to benefits, really, really, really make sure you're talking to the lender first, seeing if they can do anything for you before you stop that relationship with them, because if you cannot go back. And then credit score is really important, because there are times, and I've helped a lot of members, and this is something that sometimes we've done with our members. We actually will tell them to maybe hold off on refinancing and fix a couple of things on their credit report so that their credit score goes up. Because if your credit score increases, that may allow you to have a higher, well, let me rephrase it. If you have a higher credit score, you could then get a lower interest rate. So you can end up with higher savings on the refinance. So sometimes it may make sense to hold off a month or two, work on the credit score, and maybe you can move yourself up from one tier to another. Every company is going to be different. So what I would recommend, nowadays it's very common that you can actually get an estimate on a loan and not have it impact your credit score. It's a soft pull, and they can just tell you, hey, if you base off your credit score, you would get XYZ. Call the company and just find out, how much higher would my credit score have to be for me to get a lower rate? Us at the credit union, we're pretty transparent. We'll tell you, depends on what you're borrowing, but we can walk you through it. Some other companies may do the same. So just call and find out, because if you can just save a couple $100 more by just waiting a month or two and working on your credit score, that's something that we recommend. And it's something you don't have to do on your own. The next couple of slides, I'll give you a resource. You all have access to GreenPath Financial Wellness, and they provide free credit counseling and can help you improve your score. And thank you. I did see, I think I'm seeing a couple of questions, so we'll address those shortly. So what if all these options we went through just aren't enough? And that's okay too. We don't ever want anyone to feel bad about being in a tough financial situation. It happens. Life happens. Things are unexpected. We're literally living through a pandemic. We understand. So there are situations that even with all these options, it just may not be doable. So what's next? Another option that you have is a debt management plan. This is a situation in which you work with a company, which is a not-for-profit. In our case, it's our partners at GreenPath Financial Wellness, and they will restructure your debt with the lender so that the interest rates are reduced. You will pay them monthly, GreenPath, and GreenPath manages your debt, so they pay off your different credit cards or loans that you have. Why would someone do this? What is the benefit? Because GreenPath is a large company, they work with different lenders. So they work with Bank of America, Macy's, Chase, and I'm not sure if exactly they work with those. Those are more for examples. I know they do work with some of those, but they already have relationships with these credit card companies and businesses, so that if someone went onto a debt management plan, they may be able to reduce the interest rate from 20 to 10% or 13 to 4%. Every company will be different, but they have guidelines that the companies give them. Now, why would the companies do this? Well, they want their money, and because you're going to be working with GreenPath, they know that you're going to go through financial counseling. They also know that you're going to make a payment to GreenPath, and therefore GreenPath will pay them. So they feel more invested in reducing the interest rate to help you pay. These are highly regulated through I think it's state and federal government that regulates it, but there is a cost for it. It's $10 per month in this per account. So you can have multiple accounts on a plan. In the state of Mass, the maximum that you could be charged is $75. So if you have 8 plans, it would not be $80, it would be $75. Same if you had nine accounts, it would be $75. It's not debt settlement, and that's really, really important. Debt settlement is when you stop making payment. And when you stop making payment, then after however many years, you may be able to settle. Meaning that if I owe $10,000, but I don't pay for a couple of years, the company might say, well, just give me $3,000 and we'll just call it a settlement. That may sound like a good deal, but that's going to have a negative impact on your credit score and your report. Companies are going to be able to see that you settled your debt, and they may not want to lend to you in the future. So that's something to keep in mind. Debt management, it's with you in mind. It's really meant to help you, and it's treated more favorably. It does negatively impact your credit score at first, typically because it takes a couple months for you to get into a correct agreement and paperwork. But if for people that stick to it, their credit score does increase and they're able to pay off their debt. The next slide, we have an example of what does a debt management plan look like? What has it look like for a couple of our members? And this is just an example. The currently is without the debt management plan. If you go on a debt management plan, and GP is for GreenPath, you can see that more of your payment would start going towards the principal payment. So in the last column, you see that your benefit, if you are able to set up a debt management plan, $408 will be going towards the principal, versus if you don't go on the debt management, only $75 are going towards the principal. And why is that? It's because, again, that interest rate, you're able to reduce it by working with GreenPath. In this case, this individual, and this is an actual example, this individual paid off, well, it's estimated, they were still in the plan, that they were going to pay off their debt 40 months sooner. So again, saving time. Time is so important. We want to make sure we get as much time as we can being debt-free or with as low debt as possible. And they're saving almost $32,000. The information that I mentioned, it's through GreenPath. And GreenPath can help you with credit counseling. They can help you with budget counseling. So that's something else too. I've had people ask about, well, I don't know how much money I actually have that I can put towards debt repayment. Call GreenPath. It's free, it's confidential. It's a service that our partners over at MGB's EAP, they will refer members to GreenPath too. You don't have to be a member of the credit union. By attending this presentation, we're making it available to you and those in your household. So if you want to have someone create a budget for you, ask you the questions, and then they input it for you and email it to you, GreenPath can do that. They can also pull your credit report and help you figure out how to improve your credit score. And it's a lot of good information, and it's free because we pay for it at the credit union, because we know the importance of having a financially healthy community. And as community members, we want you to have peace of mind. And if the least we could do is provide you GreenPath, that is one of those things that we will gladly do. We talked about a lot of different things, and I'm going to open it up to questions shortly, but I'm going to just give you a little quick recap. It's good. It's hard. We understand, looking at debt and thinking about, wow, it cost me how much to have this loan? How much am I going to pay off? It can be challenging. That's why it's important, and how Sarah started today's presentation. Why are we here? What's motivating us? And go back to that, because there are going to be times that we will be tempted to, move away from our debt repayment strategies. Something will come up and we may want to do that instead. And, of course, there are times we need to give in to enjoy our money at the same time. But we have to have a good balance, and keeping in mind why we're doing it is going to be important. And educating ourselves, staying informed. I hope this is just the beginning. Maybe next you will read our blog, or you'll contact your lender, get more information so that you feel more empowered. And then the next thing is something that I hope all of you have pen and paper, or if you prefer to type it or on your phone, however you'd like. I'm going to ask you right now, this is the honor system. I can't see you, but if you're doing it or not. So keep that in mind. What is something that you can do today? Or, you need a little bit more time. What is something you can do by Saturday, by the end of this week? I'm counting Sunday as the start of a new week, but what is something that you could do in the next couple of days to help you as a next step? For some of you, it might be, I'm going to look up my interest rate. I'm going to calculate how much it's going to cost me to pay it off. I'm going to calculate how much I can save in interest if I just up my payment by $10. So I ask you to take a moment and write it down. It's important to write down your financial goals and your next steps, because most of the time when we accomplish a task, writing it down is a really important piece of it, especially when it comes to financial goals. And this is all information that we've gathered from our friends at GreenPath, and they're behavioral scientists, and they've told us that writing down the goals is very important. I do have a quick little disclaimer. I know we talked very general information. We can't tell you specifically what works best for your situation. It would be a disservice, because we don't know. We're giving a webinar, and I'm hoping, I'm picturing your smiling faces. I'm picturing a lot of faces and people happy with this information, but I don't know your specific situation. So it would be a disservice to say everyone needs to do X, Y, and Z. So just keep in mind your situation is personal, and that's why we provide additional resources. We have GreenPath, we have our website, EAP. Kimberly provided her email as well. So if you need additional support, that's what we're here to help and to support you, both through the MGB EAP and also through us at HUCU.